And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, and it is, of course, Tuesday. That means it's technically speaking Tuesday as we kind of look at the market specifically and talk about kind of where we're headed to from here. I mean, lots of stuff going on. Yesterday, of course, the anniversary of the crash of 1987 when the Dow plunged a whopping 500 points. And, this is the interesting part about this is, back in 1987 when this occurred, 500 points was a huge deal because the Dow wasn't trading at 30,000. So, nowadays we have a 500-point swing. We're like, who cares? But, it was kind of a 30th anniversary of that. So we, markets struggled a little bit yesterday. People kind of reminded that it was the 30th anniversary. No big deal, though. Markets did sell off a bit yesterday because of, no stimulus. And we're still debating on this. Well, today is the deadline that Nancy Pelosi laid out to the Senate. Said basically if you don't get stimulus done by today, you're not going to get it done before the election. So probably not going to get anything done as Senate is still working on a skinny bill of some sort, talking about $500 billion, much more targeted approach rather than this kind of real blanketed approach of just, throwing money out in the markets, which has been rife with fraud. One of the big problems is we talked about yesterday is that, people when you're just throwing money out into the markets without really any kind of system to do it, you wind up wasting a lot of money. Billions of dollars were lost to fraud during the March stimulus kind of throwout. And again, now we're trying to do this again. Still don't really have a system in place for that. Now, nonetheless here, though, markets have been doing exceptionally well. And in fact, exuberance in the market is really kind of, despite yesterday's sell-off, really kind of all the way back to where we've seen before. And we talked about this back in late August, early September. We said, hey, got a lot of exuberance here, kind of look for a correction. And we're seeing the same thing here. Our technical indicators are now all back up towards their highest levels and starting to push back up into more overbought readings for the markets. And that suggests that, markets could struggle here a bit. And we've talked about over the last couple of weeks that we could see the market kind of struggle as over the next 2 weeks as we kind of head into the election. And the technical indicators are certainly telling us that that's possible because everything's gotten really kind of extended here in the short term. And, same thing goes with just kind of overall sentiment of investors, whether it's the, professional investors or retail investors. They've pretty much gotten back to the more of the extreme greed side of the ledger in terms of their asset allocations. And again, this is more of a contrarian indicator, right? Everybody's kind of very excited here. We've been running the markets up on hopes of stimulus. That doesn't seem to be coming. So there's room here, and here's just simply the point about this, is there's room for disappointment as we really don't have stimulus coming down the pipeline at this point. Real-time economic indicators are starting to show some signs of economic deterioration now because that money that was in the system is now starting to fade and evaporate from the system. So that's leaving less money to be spent through the economy. If we take a look at just professional investors, those are all the way back to the highest, to one of the highest levels on record. So professionals all the way back in. In fact, option NASDAQ bets, right? Now, this is the most speculative form of betting on the NASDAQ, is now back at historic extremes, some of the highest levels that we've seen in history. People are just really betting on technology, and particularly in this is a fact as we go further into earnings season here. Technology is really kind of the only sector expected to show positive earnings growth. Lots of speculative bets on technology right now. Again, nothing wrong with that. This just tends to be a bit more of a contrarian indicator, suggesting that markets have gotten a little bit ahead of themselves, and you might want to take a little bit of risk off the table here. Same thing here and just talking about these options bets. Large bets on options have really started getting back up to more extreme levels. Last time we were at these levels, had that correction back in September. Again, doesn't mean the market's going to crash. It just means you're going to have a little bit more volatility. That's all that means. And again here, when you take a look at the kind of the positioning of newsletter writers as well. They're all the way back. Market timing newsletters back to very, very bullish levels. Again, just a contrarian indicator. Doesn't mean the market's going to crash, but it does mean that you're likely to have a pickup in volatility in the markets. And particularly when we talked about here over the next couple of weeks, lots of uncertainty here as we head into the election about who's going to win, right? And whose policies it's going to be. And really, the big risk is not the function of a Biden win or a blue wave or a red wave or a Trump win. That's really not the big concern. The big concern for the markets will be a contested election where we don't know the results. Something we talked about in this past weekend's newsletter, which is on the website now, realinvestmentadvice.com. The last time that we had a contested election, talked about this yesterday, was the Bush-Gore election back in 2000, and that led to about a 7.5% decline in the markets because, well, the markets didn't know who was going to win. And again, markets will adapt very quickly. Get a Biden presidency, they're going to adapt pretty quickly to higher taxes. You get a Trump win, markets are going to adapt pretty much to status quo of know what you're going to get with President Trump. Markets will adapt to that very quickly. What they can't adapt to is not knowing. And that's going to be one of the big risks here. And again, with markets kind of extended here, exuberance high, that really suggests that you've got potential for a bigger correction over the course of the next few weeks, particularly if we do get into a position of a contested election. Now, talking about the economy in particular, as we were saying a second ago, without stimulus, we're beginning to see disappointment in a lot of the economic data. The Citigroup Economic Surprise Index has turned lower here because more and more of the economic data that's coming in is not beating expectations. So expectations for the economic data is very high, but the actual numbers we're getting are less than that. So again, we're starting to see a correction in the economic surprise index as stimulus really kind of begins to fade through the economy. And again, today's kind of that deadline. Again, whether or not we're going to get more stimulus is the question before the election. Most likely it's going to be after the election. And of course, after the election, there's going to be a period lag, particularly if Biden wins the election. We may not see stimulus until really 2021. So could be a bit of a drag here, could actually put some more risk into the markets, and as well as a kind of a recontraction, kind of that, what people have been talking about is a W-shaped recovery, where you have a bit of a V-shaped recovery, another decline, a kind of a recessionary spat in the economy, and then you begin a recovery. That may be what the case turns out to be, particularly if we have a long break here without any type of stimulative support for the overall economy. Real quick on the markets themselves, though, on a short-term basis, markets are still doing just fine, holding above the 20 and the 50-day moving average. Trend is positive. We did have this correction yesterday, about a 1.5% decline. But again, still above support. Markets look to be opening up this morning again on hopes of more stimulus. More concern, though, really, when we get into the longer-term weekly trends. Trend is clearly very bullish here from the 2009 lows. Bullish uptrend, very much still intact. But we do have some negative divergences in relative strength, which suggests that we could see a bit more volatility here. And again, the long-term picture is still really kind of bearish here. Markets are still within a well-confined kind of megaphone pattern as we kind of really push up against the top of this long-term trend, as well as we're getting very, very overbought on a monthly basis as well, suggesting that we could see a bit more of a correction here. Maybe in 2021, we have another leg of a correction, particularly if we don't start seeing some better economic recovery and kind of really kind of getting things back on track. That's kind of a quick market wrap this morning for kind of what's going on. But today is technically speaking Tuesday. The article, all the charts, everything on the website right now at realinvestmentadvice.com. We'll come back after the break, get into the story about stimulus, where we are, what it means, what's going to happen next, and what we think is going to happen as we get into the election. More on the Real Investment Show coming up. realinvestmentadvice.com. Be right back.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live GoToWebinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
This morning it is 6:20 as we kind of get the show underway this morning. It is, again, technically speaking, Tuesday. So, again, that article on the website now, realinvestmentadvice.com. So, rapper 50 Cent, he's upset. He's a tad upset. Rapper 50 Cent has now endorsed President Trump for the upcoming election because he happened to look at, just happened to look at Biden's tax plan. And, with top tax rates in California being 62.6%, New Jersey 60%, New York State 58%, New York City 62%. He's like, no way. And this is one of the problems with, trying to, launch exceedingly high tax rates. And again, there's a lot of premise behind this. People go back to the 1940s and they say, well, there was a time in history where we had a 90% tax rate. Yes, we did. Nobody paid it. It was on incomes of $5 million or more back in the 1940s, which nobody made that kind of money. It was kind of more of a statutory tax rate. And nobody actually paid a 90% tax rate on their income. So when you start trying to throw out these exceedingly high tax rates and people catch on to it that are making money, it tends to change the dynamic of the game here a bit. Taxes do matter. And look, I mean, it's one of those things that, we do have a problem. We have a spending problem. And under the Biden plans, he wants to spend, $10 trillion on a variety of, green energy projects and infrastructure development, all great, all fine stuff, right? But you got to pay for it. And there's only a couple of ways you can pay for it. One is that you've got to raise more revenue from income from other investments. Well, we don't have a lot of that anymore. So we have to do it through taxes, tax revenue. And the problem with, taxing the wealthy, and we've gone through this math before, when you're running a $3.1 trillion deficit right now, which will be closer to $5 trillion by the end of the year if we get another stimulus package, and you're running roughly $28 trillion in debt, you can take all the wealth from all the top 10% of the people in the country, right? Just take every single dollar of it. Tax them 100% of all their money. Right? Just take it all away. You won't even put a dent in the debt. And then what are you going to do next year? Right? You've already taken all their money, so they've got nothing. So what are you going to tax next year? So, the problem with exceedingly high tax rates is that, first of all, the people in the top 10% of the economy pay about 50% of all the taxes already. And so when you start taxing them more, they're going to move and shift assets elsewhere, right? Because they have the means and the will to do it. Okay, so now you've reduced your taxing ability because now they've shifted assets offshore, and also the top 10% of wealth in the country is what also generates a large chunk of the employment. So now you lose employment. And this is the problem with higher tax rates. Higher tax rates don't promote economic growth. It actually slows economic growth, and you're already running at very slow rates of economic growth already. So now, look here, by the way, let's just, be clear about this. This is just the proposal, right? What actually gets passed is an entirely different thing. In order to pass these kind of tax rates, you're going to have control of the House, the Senate, and the White House. And I even doubt that it's possible that a lot of even the Democrats will vote for these kind of tax rates, particularly in their state. Can you imagine, Democrats voting to put a 60% tax rate on New Jersey and New York City, where a lot of your wealth is concentrated? I have a feeling that they might be losing their job if they try to do that. So again, trying to get these things passed is an entirely different story. But it is the point about this is the impact of this, right? So, higher tax rates sound great on surface, right? We'll just tax the rich more. It'll solve all of our problems, and it won't. You have a spending problem. You have a debt problem. And you can't grow your way out of a debt problem by issuing more debt. So if you want to raise taxes, okay, great, raise taxes. But you've also got to cut your spending. This was the problem that we had with the tax cuts. And I had this conversation with Congressman Kevin Brady at the time here on the show. I said, it's great you're going to cut taxes, which means you cut revenue to the government, but you also have to cut spending. So that way, the growth that you get in the economy from lower tax rates, you can bring in that revenue and then offset your debt, right? And it's like, yeah, we're going to cut spending. Well, we never cut spending, right? In fact, we increased spending. So the entire impact of the tax cuts was wasted because we never cut spending. But if you're going to raise taxes, great, fine, dandy, whatever, you've also got to cut the spending. But see, there's no will to cut spending, and the general attitude is, oh, we'll just raise taxes and that'll pay for everything. It won't. You'll wind up with slower economic growth. You'll wind up with people shifting their assets offshore to other places to not pay taxes. So you won't actually collect a 60% tax rate, but you'll wind up getting slower economic growth, slower investment in the economy, etc. That's what tax rates do. Tax rates are punitive. If you're raising them, they're punitive. So, so again, you can kind of understand, here's, rapper 50 Cent. He makes a good bit of money doing his thing, acting. He does acting, rapping, all kinds of stuff. And he's like, hey, wait a second. You want to come tax me 60% of my income? I don't think so. Because all of a sudden, 50 cents was what, about 32 and a half cents? 25 cents. So that's the point. So, but it's interesting here because people are waking up to this idea, right? I mean, this whole idea of modern monetary theory, and we've talked about this on the show before, is that, debt doesn't matter. It's free. We don't ever have to pay it back. We can just print money to pay for it. We're living that right now, right? Where let's just throw out another $2 trillion in stimulus. Sounds great, right? It's all debt. We're just issuing debt to give people money, but we're issuing debt that is non-productive. Once we give people money, they spend it, it's gone, right? There's no long-term return on investment. And here's the trap we're getting into, and you're seeing it right now real time. So we did stimulus back in March. Fine. That was kind of a Band-Aid. We shut the economy down. We told people to go home. You can't come to work. You've got to stay locked up in your house. Okay, great. You give them some money to tide them over. But now it's gone. And now you've got to go and issue more stimulus because that money you gave them was gone. It wasn't invested in creating new businesses or other lines of income, creation of jobs, etc. It was just spent. And now that it's gone, everything's starting to slow back down again. Everybody's like, hey, you got to give me more money. Okay, great. We're going to give you some more stimulus. So we give you more stimulus. Well, that money will be gone. But every time we do this, we run up the debt, which is a long-term requirement of payment because we've got to service the debt. So we're using this debt to create one-time injections into the economy that once they're spent, it's gone. It doesn't create a long-term productive outcome to help pay for the debt, right? We're not investing it into building a nuclear power plant that people can then use to get power and is going to create jobs and everything else. And people are going to pay for that power for decades, right? that will pay off the debt. We're not doing that. We're just giving people money saying, hey, go spend it in the economy. Once it's spent, it's gone because it's not creating jobs for them. If you take a look at layoffs every week, we're clipping off 800,000 to 900,000 new layoffs. These layoffs are now becoming permanent. We're seeing more and more permanent job losses in the economy. So that's the problem with all this. Taxes are fine. We can raise taxes, but you got to cut the spending because it's the debt that's the problem. It's not the taxation. It's the debt that's the problem because it's consuming more than 100 cents of every dollar that you're bringing in just to pay on the debt. Service mandatory spending like social welfare. That's where all your money's going. So there's nothing left over to invest back into growth in the economy. Quick break. We'll be right back.
How you like that? You don't like that? You like that?
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live GoToWebinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Welcome back to the show this morning. It is, of course, Tuesday as we kind of get this month underway. We're just 2 weeks out now from the election. Just debates are coming up. We're going to have muted mics, and this is going to be full of entertainment for sure.
And if that doesn't work, we'll use shock collars.
Exactly. That may be the next thing, right? So, we'll see how this whole debate thing goes. But, so, that's kind of where we are. Now, futures are pointing up this morning as expectations are, again, we're going to get a stimulus bill. Apparently, Steve Mnuchin, the Treasury Secretary, and Nancy Pelosi spoke yesterday. And apparently between Nancy Pelosi's rambling and Steve Mnuchin not remembering where he was half the time, they did manage to move forward on some type of bill. Again, there's still no consensus on trying to get a bill done at this point in terms of getting differences kind of worked out. Nancy Pelosi still wants things that the White House and really Republicans are not going to agree to at this point, particularly when it comes to large amounts of money delivered to states. So that's still remaining a problem here. But the hope is, again, what markets are pointing up this morning, Dow's up about 208 points this morning, is that we're going to get something done today. And then that will give them time to try to get it passed, here before the election. President Trump clearly on board at this point. I don't care how big the number is. I'll pass it, right? Just get a stimulus deal done. I'll sign off on it. And this is the danger, right? This is what we were talking about a second ago. The debt's the problem. And instead of thinking logically about, how to do stimulus, right? What's the real need for stimulus at this point? What are the areas? Like, for instance, let's talk about PPP, the Payroll Protection Program. There's still money left over in the PPP program from the original program that we did. It wasn't fully utilized. So do we need to do more of that, right? We saw a lot of money. We saw billions of dollars get taken up by companies that really didn't need it. Right? They were publicly traded companies. They had access to markets, but they took PPP loans anyway because we didn't really have guidelines in place for getting that money specifically just to small businesses that needed it. So billions of dollars were wasted. We had a lot of fraudulent claims for PPP program. Several billion went out that door.
So the problem with doing this is that these things are always rife with fraud because people are going to figure out how to do it. We talked about yesterday about the rapper that got $1.2 million worth of jobless claim checks, right? And got arrested for it. He'll serve about 22 years in prison.
Nuke Bizzle.
Faux
shizzle.
But yeah, absolutely. But that's the problem with these programs. So we need to think about, how we're going to do these programs. Where's the money actually needed? And what's the best method to get it there to where it has the least amount of potential for fraud and theft and loss, right? Just basically loss. But we don't do this. We're just in such a rush to do something that we're trying to just get it out there, right? And so this is why we wind up with, a lot of waste in these programs. The Main Street Lending Program was another program that was put together to help kind of Main Street businesses, right? $600 billion was put together by the Federal Reserve and the Treasury to fund the Main Street Lending Program. It's only had about a $2 billion uptake. It's not needed. So again, money sitting out there not being used, but we're paying interest on the debt. So that's the point about this. So anyway, futures are up. Speaker and Mnuchin spoke for about 53 minutes yesterday, talking about their deal. They hope that by the end of the day today, that we'll have some clarity on whether we'll be able to pass a bill before the election. And again, the problem now is that everybody's about to gear up for the election, right? I mean, it's about to just shut everything down. So if they don't get something done today, they're just not going to have time to try to get, Congress and Senate to pass a bill, to get it up to the White House, to get it signed, go through that whole circus to get it signed before the election. And of course, they don't get it signed before the election, then all bets are off because depending on who wins or who doesn't win or whatever, there's going to be probably a good bit of contention over what happens next. Mitch McConnell, he's filed cloture on his new $500 billion coronavirus package. Now, remember, Mitch McConnell is against doing any type of big package. He kind of gets it. He's like, look, we're running a $3.1 trillion deficit. We're going to throw another $2 trillion on top of that. We can't pay for it. I realize we need to have some stimulus, so let's do a $500 billion deal. Let's get some let's get some unemployment benefits out there. Let's get some direct checks to households. Let's fund PPP, and let's do that for now, and then we'll figure out what we need to do next. So he's filed cloture on that. That's going to ripen for procedural vote to end the filibuster. He needs 60 yays to pass that bill. That's likely going nowhere. He doesn't have the votes for it. So the real issue now, of course, is just everybody's kind of left hanging. Markets are running from one day to the next on hopes for stimulus. Why? The Federal Reserve cannot do more QE. And if you take a look at the Fed's balance sheet, it's basically been sideways now for the last month or so. They can't inject more liquidity into the markets. They can't ramp up their bond buying unless they have new issuance of bonds from the Treasury. The Treasury can't issue more debt unless they have a stimulus package that they've got to fund. You follow? So this is all the inner workings. Basically, the Treasury issues the debt to fund the stimulus program. The Federal Reserve then takes that debt. They buy it, basically. They monetize it. They can then leverage that debt 10 to 1 and do more QE into the markets. That's why markets are running up. And that's why markets are hopeful for another stimulus package, because that means more liquidity for the markets, more money. But again, there's consequences, right? It's all fine and dandy in the short term. The problem is long term is that, we're still got to deal with the debt. We've got valuations that are extraordinarily high. I mean, we're just vastly overpaying for what the earnings are for companies. Economic growth is weak. Even though it's recovering, it's still very weak. Revenue for companies comes from the spending that people do in the economy. So You have a weak economy and high valuations. In fact, a large chunk of the advance in the markets, in fact, almost all of it, has been from what's called valuation expansion. In other words, we're not paying for more earnings. We're just paying more for the earnings that we're getting. That's all. And so we're right in the middle of earnings season here. Over the course of the next couple of weeks, it's going to be the big bulk of earnings. Technology is going to do okay, earnings-wise. A lot of the other sectors of the economy aren't really doing all that well. Their earnings are going to beat, right? Because we've lowered that bar so much. We talked about this yesterday, is that, we're back into millennial soccer season here, where we lower the bar so much that everybody can beat their earnings, right? It doesn't mean that we're getting better quality earnings. It just means they're beating a much lower bar. And so you'll hear all these headlines out. It's like, well, 86% of companies have beat earnings. Yeah, that's great. If you lower them enough, yeah, everybody's going to beat them. And that's exactly what happened in the month before earnings season started. Earnings were lowered by over $5 per share. So that made it much easier for these companies to beat earnings, right? We're paying more for less. And that's because of the economy. While people will tell you that there's no, the stock market's not the economy, yes, it kind of is. Because ultimately, their earnings come from economic growth. What we do in the economy, what you and I go out, we spend and we buy and we consume, that's where the earnings come from, right? Procter & Gamble this morning announced very good earnings. Stock's going to be up a couple of bucks today. But where does Procter & Gamble get their earnings from? Doesn't come from, the magic fairyland of earnings, right? Comes from what you and I buy, right? We're going to buy their products. They're a consumer staples company. So what you and I buy, that's where their earnings come from. All right, quick break. We'll come back, wrap up the show. I'm your host, Lance Roberts. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
Who will win the election in November? How will that decision affect your decisions for your retirement? Richard Rosso and Danny Ratliff's next Candid Coffee can answer your questions about money, retirement, risk management, and how to identify and protect your household against financial vulnerability, regardless of who's elected. Send your questions and join this live GoToWebinar event at realinvestmentadvice.com. Candid Coffee with Ratliff and Rosso at realinvestmentadvice.com.
Welcome back to the show this morning. Yelp wants to give adult children $2,000 to move out of their parents' houses. I got 4. Actually, one's out already. So I got 3.
Who are they going to pay it to?
I
to
guess,
the kids?
Yeah. Here's the story. Over half of young adults, or basically 26.6 million of those between the ages of 18 and 29, live at home with parents as of July. Now, that's an interesting statistic because that's levels we haven't seen really since the Great Depression, right? So you've got all these young adults still living at home. My kids have a very strict mandate. At 18, they're out of the house. So you either go to college or go to work, one of the two. You have your choice. But it's interesting because, you've got these millennials now living at home, 18 to 29. They've gone to college. They've gotten, supposedly got degrees, and they can't find work. And this is part and parcel of the problem that we were talking about before with what's going on with equity and the economy and debt. You take a look at the financial markets, right? Everything looks great, right? We're near all-time highs. So obviously the economy's booming, but it's really not. And you take a look at the number of people that are unemployed, the number of people, living on some form of government assistance. We're near all-time records, right? Multi-generational families are now at the highest level on record since the Great Depression. right? So the economy overall may seem to be doing okay, but 2% economic growth does not create economic prosperity, and it does not fulfill the requirement that you need to absorb population growth over time. You need stronger rates of economic growth to do that, and we don't have it. We haven't had it in a decade. And the stuff that we're doing now is only going to make it worse. Debt, deficits, they don't create economic prosperity. So Yelp has an interesting idea. They're saying, hey, we'll give you $2,000 to move out of your parents' house. Okay, great. Give me $2,000. Sounds like a lot of money, right? So I move out. I get an apartment. But guess what? I still don't have a job. So this is the problem with all of these stimulus ideas, right? They all sound great. They're Band-Aids, right? It helps me today, but what about tomorrow? So great, give me $2,000. I move out of my house. I go get an apartment. I still don't have a job. And next month, the rent comes due again. And now I don't have any money to spend because I moved out of my parents' house. So guess where I go? I go back to the parents' house, right? And the parents are like, nope, can't come back. See ya.
Can you even get an apartment without having a job?
I'm sure you can.
Don't they run applications on people
Yeah.
and say, how are you going to pay your rent?
Yeah. I'm sure they do. I haven't rented an apartment in 400 years. So,
Well, me too.
but yes, I'm sure. Yes. Because they do run credit checks to make sure you're going to pay.
Yeah.
Right. So,
Sorry, Yelp.
well, no, I mean, it's just an interesting idea, right? I mean, everybody wants to try to help these millennials, right? Let's do stuff. But, just for instance, if you take a look at a lot of companies, right, they're migrating more and more to technology to replace employment, right? Kiosk at restaurants and ordering services. Here's a good example of this. Shoppers this year plan to visit fewer stores. And part of that reason is because we have now shifted because of, locking everybody down and saying, hey, you can't go out. You've got to stay home. Well, we've now trained everybody to shop online, right? Our household is a good example of this. My wife orders online groceries from Walmart or from, Kroger's. She picks them up. They bring it out to the car. She brings them home, and that's it, right? Everything else comes from Amazon. So what we've done is we've reduced the need for retail salespeople. Well, those are jobs that are gone. Think about all of the commercial retail space that we have around the country. Malls, shopping centers, all these type of things. All those companies, businesses are having to adapt to a new environment. Now, look, there's some essential businesses. I have a friend of mine that builds retail strip centers. Completely changed his model now. He only puts in stores that people have to come to, right? For the most part, right? Hair salons, nail salons. You can't order a pedicure and a manicure from Amazon, right? You can order the kit and do it yourself, but if you want it done, you got to go somewhere. So, but it's this is the idea, right? You've got to adapt to kind of this new environment that we're in. But the problem is the new environment that we're moving to is creating less jobs, not more jobs. We're replacing more and more jobs with technology. One of the, kind of the big employers in the country is real estate, right? Think of all the real estate agents we have, right? You go get a real estate agent. They drive you around from house to house to house to house. You look at all these houses, right? Moving more of that to online, right? Shop online, buy online. Don't need a real estate agent anymore. Going to replace a lot of that business. But this is that's the dark side of technology. We all love technology, right? It certainly makes our life simpler, certainly makes our life more productive, right? But there's a dark side. Less humans. And again, it's the point here is that, we need to think seriously about the things that we do, because they have a long-term economic impact. We want stronger economic growth. Stronger economic growth requires productivity. We have to go produce something to have stronger economic growth. And if we're not producing, then we don't get a paycheck. And if we can't get a paycheck, we can't consume, right? So consumption is the key. We're basically, our economy is almost 70% based on consumption. So if people aren't out earning a paycheck, they can't consume. The more paycheck they earn, the more they can consume, right? And this is why, though, we have all these calls for socialistic policies. I can't get a job. I can't make ends meet. I need the government to bail me out. But recycling tax dollars is not creating economic prosperity. It actually has a negative, what we call a negative multiplier effect. It actually has a negative impact on economic growth long term because we have to service the debt, as we were talking about earlier. So the debt's the problem. And, and again, look, the government's not a household, but in a lot of ways they are the same. If you've got a tremendous amount of debt in your household, everything you've got coming in income is just going to service the debt, right? It's stressful. It's terrible. You can't make ends meet. If you don't have a lot of debt, you've got a lot of extra cash flow, you can go out and buy a new car, you can go buy a new house, you can do whatever you want, right? You've got lots of free cash flow. Life is so much easier if you have cash flow. And in many ways, the government's the same way. Yes, I know there's differences, and I'm not saying they're exactly the same, but you get the idea, right? It's the point. If you want better rates of economic growth and prosperity, you've got to move in that direction. But unfortunately, the things that we're doing, the choices that we're making, and a lot of this is being dictated to us, right? You can't go out. You got to stay home. You got to do these things. They're changing and forcing this behavior that is not necessarily economically beneficial long term. So these are just some of the things that we need to think about. Dr. Scott Gottlieb says in about a week, we're going to have a rapid acceleration of coronavirus cases. Here's an interesting byline to this. As of week 40 of this year, we have one of the lowest rates of influenza in total cases. Normally, we run about 80 to 90,000 influenza cases every year. We're like 19,000 right now. So, well, yeah, wearing masks, whatever it is, but
washing hands.
Yeah. So we're combating the flu.
I usually have seasonal allergies. Mm-hmm. Haven't had it this year.
Really?
Because I've stayed in this room all day, every day. And when
you've been quarantined.
When I go out to the store, I got to wear the stinking mask, so no pollen up my schnoz.
There you go.
It's been great.
See?
But I'm lonely.
You're lonely. Yes, this is the case. So, yeah, low cases of influenza, but Dr. Scott Gottlieb says in about a week, we're going to have a rapid acceleration of coronavirus cases. And, look, we're seeing rapid accelerations in South America, kind of other countries as well, rapidly increasing cases of coronavirus. So, this next wave of the virus is coming. And the question will be, what do we do, at that point? Are we going to lock down the economy again? Do people kind of contract again? These all have consequences economically that we're going to have to deal with. And again, at some point, we've got to get past this and, get people back to work. People, if you want economic growth and prosperity, you've got to get people back to work. And you've got to get them back to being productive. And you've got to get them back to earning a paycheck so they can consume. It's just the economic cycle. And, as we said before, bailouts are fine, but there's a consequence. And at some point, we've got to start the focus being getting the economy back to operating. Now, whatever form that is, everybody works at home, great, whatever. But you got to get people back into the process of producing and consuming. And you've got to get millennials to work. Right? Because they're the next big generation that's coming up. They've got to move out of the house. They've got to get into the workforce. They've got to start producing and consuming if you want them to take over the mantle from the baby boomers, which are retiring and dying off now, right? So we're moving through that economic and demographic cycle. Demographics are destiny for any economy. All right, wraps up the show for the day. Be sure and get by the website today, realinvestmentadvice.com. We'll have our blog post out this morning already, technically speaking. It's up and running. But also get registered for our Policies, Not Politics webinar. It's this Saturday at 8 a.m. It's a webinar. If you register online, we're going to talk specifically about politics and policies and what that means for the financial markets and investing and markets over the rest of this year. And of course, the big question will be, what about 2021? That's going to be the big issue. That's going to be this weekend, though, from 8 to 9 a.m. I'm joining Richard Rosso and Danny Ratliff, CFPs, to talk about policies, not politics, and the effect on the markets. Of course, we'll also talk about Social Security, Medicare, Medicaid, all those other type of financial planning, retirement information that you need at this point. Just go by the website, realinvestmentadvice.com. It's absolutely free. Just click on the banner there for the Candid Coffee. It's Saturday morning from 8 to 9 this Saturday. So get registered now. We'll send out the link to you and everything, have you taken care of. Get by the website, realinvestmentadvice.com. Send your questions, comments, emails, whatever we can do for you. Happy to do it. And always happy to help you. And again, our newsletter is out, our latest blog post and more, all there at the website, realinvestmentadvice.com. Have a great day. And we'll see you tomorrow on the Wednesday edition of The Real Investment Show. Get by the website again, realinvestmentadvice.com, but stick around because Chris Salcedo is coming right up.
It's a rich man's world.